If you observe carefully what's happening in financial markets right now, you'll notice something deeply troubling. While retail investors pour money into stocks at record levels, institutional players are quietly repositioning. Corporate insiders are selling at ratios not seen since 2007. Warren Buffett's Berkshire Hathaway is sitting on $325 billion in cash, the highest level ever. Jamie Dimon at JP Morgan has been selling shares for the first time in nearly 2 decades. Mark Zuckerberg has sold billions in Meta stock. These aren't emotional decisions, they're calculated exits. Smart money isn't buying the dip anymore, they're creating distance. And if you don't understand why, you're about to learn what nobody is talking about. A convergence of forces that will reshape wealth distribution in America more dramatically than anything we've seen in 50 years. This isn't a prediction. It's a logical consequence of observable mechanisms that have governed markets through every major cycle in history. I've spent over 40 years studying how debt cycles, credit expansion, and monetary policy create predictable outcomes. When you understand incentives, you understand behavior. Central banks are incentivized to prevent deflationary collapse. Governments are incentivized to maintain asset prices to preserve tax revenues and social stability. And investors are incentivized to chase returns wherever they appear. Right now, these incentives are colliding in ways that create systematic fragility. The S&P 500 trades at a Shiller P/E ratio of 32, compared to a historical average of 17. Stock market capitalization to GDP stands at 185%, exceeded only briefly in 2021 and 2000, both times preceding major crashes. Margin debt remains near $750 billion despite recent rate hikes. Corporate buybacks, the primary driver of stock gains since 2015, are declining as cash flow pressures mount. These aren't warning signs, they're mathematical certainties of what comes next. Think of the stock market as a restaurant that's been offering free food for 15 years. From 2009 to 2024, central banks provided essentially free money through zero interest rates and quantitative easing, totaling over $25 trillion globally. This pushed trillions into stocks because there was nowhere else to go for returns. Bonds paid 1 to 2%, barely enough to cover inflation. Cash and savings accounts earned effectively nothing, losing purchasing power every year. Real estate became expensive after recovering from 2008, so everyone crowded into the stock market restaurant, packing it beyond any reasonable capacity. The restaurant became so popular that people started borrowing money to get in, using margin accounts and options to amplify their bets. Now the restaurant is charging for food again through higher interest rates. The Federal Reserve raised rates from 0 to 5.5% in less than 18 months, the fastest hiking cycle in 40 years. Simultaneously, the kitchen is running out of ingredients as corporate profit margins get squeezed by wage inflation up 6% annually, energy costs that doubled from 2020 to 2022, and deglobalization forcing companies to rebuild expensive domestic supply chains. Consumer spending is slowing as credit card debt hits $1.2 trillion and delinquencies rise. But people keep piling into the restaurant because it's all they know. Their 401k contributions automatically buy stocks every paycheck. Their financial advisors tell them to stay the course. When they finally realize the free meal is over and the food quality is declining, the stampede for the exits will be violent. And with everyone trying to leave through the same door simultaneously, most won't get out before prices collapse. 4 critical pressures are building simultaneously. Real interest rates turned positive for the first time in 15 years, making bonds competitive again. Corporate profit margins at 12.8% are reverting from historical 10.5% as labor costs rise. AI investment has created massive capital expenditure without productivity gains. Most critically, $4.7 trillion in corporate debt matures between 2025 and 2027. Companies that borrowed at 3% will refinance at 7%, crushing profitability and forcing dividend cuts. History is an excellent teacher if you're willing to examine its lessons without bias. In 1929, stocks traded at 30 times earnings, with record margin debt accounting for 12% of total market value. Retail participation reached historic highs as ordinary Americans poured life savings into equities, convinced the boom would last forever. Sound familiar? The subsequent crash wiped out 89% of stock value over 3 years. It took 25 years for the market to fully recover those losses. Lives were destroyed, fortunes evaporated, all because people believed this time was different. In 1973, after a strong decade of returns in the 1960s, stocks peaked with similar valuation metrics to today. The Dow traded at 18 times earnings, considered expensive then, though modest by current standards. Then came the oil shock, wage price spirals, and simultaneous inflation and economic stagnation that economists said was impossible. The S&P 500 lost 48% in less than 2 years, from January 1973 to October 1974. If you had $100,000 invested, you watched it shrink to $52,000. The psychological damage was immense. Many investors who sold near the bottom never returned to stocks, missing the subsequent recovery and spending decades in low-yielding bonds. The 2000 dot-com bubble saw technology stocks reach absurd multiples. Companies trading at 100 to 200 times sales, not even earnings, because most had no profits. Pets.com, Webvan, Cosmo.com, remember those? Billions in market value evaporated within months. The Nasdaq peaked at 5,048 in March 2000 and didn't recover that level until 2015. 15 years of zero returns if you bought at the top. The broader S&P 500 eliminated $5 trillion in market value. Retirement accounts were devastated. People in their 50s planning to retire had to work another decade. Most relevant is 2007. From 2003 to 2007, stocks climbed steadily on easy money and strong corporate profits, driven by leverage and financial engineering. Everyone believed in the Goldilocks economy. Not too hot, not too cold, just right. Housing prices would never fall nationally, they said. Banks had diversified risk through derivatives. The Federal Reserve had conquered the business cycle through masterful monetary policy. These weren't fringe opinions, they were mainstream consensus. Then the Fed raised rates from 1% to 5.25% to combat building inflation pressures. Liquidity dried up gradually through 2007, then suddenly in August when credit markets froze. The S&P 500 lost 57% from October 2007 to March 2009. The average retirement account lost $250,000 in value. People approaching retirement had to radically adjust their plans. Some never recovered financially. Today's situation carries similar DNA. Extended monetary easing creating artificial stability, record valuations reflecting optimism rather than fundamentals, tightening liquidity as central banks reverse course, and massive hidden leverage through options markets where notional exposure exceeds $40 trillion, and derivatives where interconnections can cascade failures across the system. The ingredients for catastrophe are present. The only question is timing. To understand why you should stop buying stocks in 2026, you need to understand 3 fundamental principles. First is valuation gravity. Prices don't rise infinitely above fundamental value. Think of a rubber band stretched to its limit. The snapback becomes more violent. The S&P 500 at 32 times earnings means investors pay $32 for every $1 of profit. Historical average is 17. For stocks to justify current prices, earnings must double or discount rates must fall. Neither can happen. The math doesn't work. This principle applies with devastating force when leverage is involved. For every dollar of equity, there's 55 cents of debt through margin loans and derivatives. When prices fall, leverage amplifies decline. A 10% drop triggers margin calls, forcing sales, creating 15% drops, triggering more calls. Retail investors use options at 5 times 2019 rates, providing temporary support that will accelerate declines when prices turn. Second principle is liquidity illusion. Markets appear liquid when everyone wants to buy, but this disappears when you need it most. Think of a restaurant with one emergency exit: fine during meals, fatal during fire. In 2008, money market funds broke the buck and corporate bonds became unsellable within days. Today's market has greater illusion through high-frequency trading and algorithms that withdraw during volatility. Index funds and ETFs representing 40% of ownership must sell everything proportionally during declines, eliminating diversification benefits. In the next crisis, you'll see how quickly the ability to exit disappears. Third principle is opportunity cost in a rising rate environment. For 15 years, stocks were the only game. Today, Treasury bills yield 4.8% with zero risk. Investment-grade bonds yield 5.5% to 6%. The extra return for stock risk is only 3% to 5% versus the historical 7% to 9%. Many investors will rationally shift to safe bonds. Public pension funds already reduced equity from 52% in 2021 to 46% in 2024. Retail hasn't caught on yet. Let me tell you a story about two investors through 2000 to 2010. In early 2000, Michael and Jennifer were both 42, earning $140,000 annually, with $420,000 in retirement accounts invested in stock index funds. Michael followed conventional wisdom. Stay invested long-term, don't time markets. He kept contributing $18,000 annually, buying stocks regardless of price. Jennifer attended an economics lecture in late 1999, discussing valuations and debt cycles. She moved 60% of her account, $252,000, into treasury bonds and money market funds, keeping 40% in stocks. The Nasdaq lost 78% from March 2000 to October 2002. The S&P 500 fell 49%. Michael's portfolio dropped from $420,000 to $235,000, despite continued contributions, a $185,000 paper loss. Jennifer's stock allocation fell from $168,000 to $95,000, but her bonds grew to $275,000. Total, $370,000, far less severe. In 2003, when stocks had fallen 50% and valuations became reasonable, Jennifer moved $150,000 from bonds back into stocks at low prices. By 2007, Michael's portfolio recovered to $680,000. Jennifer's stood at $810,000, a $130,000 advantage from reducing risk in 2000 and redeploying smartly. Then 2008 hit. Michael stayed fully invested. His portfolio peaked at $780,000 and crashed to $380,000 by March 2009. Jennifer, monitoring debt levels, moved 50% to cash and bonds in mid-2007. Her portfolio stood at $595,000 versus Michael's $380,000, a $215,000 difference. She again bought stocks at depressed 2009 prices. By 2016, approaching retirement at 58, Michael's buy and hold generated $1,240,000. Jennifer's risk-aware approach generated $1,685,000, $445,000 more, or 36% higher returns, simply by recognizing when risks were elevated and reducing exposure before the crowd panicked. This isn't made up. It's the pattern through every major cycle. Disciplined buy and hold does okay over very long periods, but suffers tremendous volatility. Understanding cycles and adjusting exposure maintains higher average returns and lower maximum drawdowns. Now let's translate this to what really matters, how this affects you today. If you're 52 years old with $950,000 in your retirement account, with 80% in stock index funds, 15% in bonds and 5% in cash, you need to understand your exposure. You have $760,000 in stocks, $142,500 in bonds, and $47,500 in cash. You're planning to retire at 65 with a target of $1.8 million, requiring 5.2% annual growth. Your advisor tells you to stay invested. The market has averaged 10% annually, he says. You're ahead of schedule. Here's what happens in a scenario mirroring 2000 to 2002 or 2008 to 2009. Over 18 months, stocks fall 45% as rates stay elevated and earnings disappoint. Your $760,000 in stocks drops to $418,000. Your long-duration bonds fall 10% to $128,250. Your portfolio falls from $950,000 to $593,750, a $356,250 loss. You keep contributing $23,000 annually, buying the dip. Recovery takes 7 years. By 59, your portfolio recovers to $1,150,000. You've made back losses, but you've lost 7 years of compounding. If you'd avoided the 45% drawdown, your $950,000 growing at 6% annually would be $1,427,000, $277,000 more. Now consider the alternative. In January 2026, you recognize the warning signs and move 50% of your stock allocation to Treasury bonds and cash. You now have $380,000 in stocks and $522,500 in bonds and cash. When the market falls 45%, your stock position drops to $209,000, but your bonds grow to $560,000. Your total portfolio is $816,500, a loss but far less severe. 18 months later, you have $560,000 in dry powder. You move $350,000 back into stocks at 45% discounts. Over the next 5 years, when stocks recover, you profit massively from the lower entry point. By 59, your portfolio is $1,640,000 versus $1,150,000, a $490,000 difference, or 42% more wealth. Based on these principles, here are practical guidelines. I'm not providing specific investment advice, but I'm sharing the framework sophisticated investors use. A defensive allocation might look like this: 25% in diversified stock index funds or quality individual stocks, 35% in treasury bonds or investment-grade corporate bonds with 2 to 5 year maturities, 15% in treasury bills or money market funds, 15% in precious metals like gold and silver coins, and 10% in alternative assets like commodities or inflation-protected securities. The stock allocation should focus on quality over growth. Companies with strong balance sheets, consistent free cash flow, low debt, and sustainable dividends. Avoid high multiple technology stocks at 50 to 100 times earnings. Avoid companies dependent on cheap financing. These will be destroyed in corrections. The bond allocation needs careful attention to duration. Don't buy 30-year bonds in a rising rate environment. Stick to 2 to 5 year maturities. Consider Treasury inflation-protected securities. The cash and Treasury bill allocation provides optionality, capital to deploy when stocks fall 30% to 50%. This separates successful investors from unsuccessful ones. What to avoid is critically important. Don't continue dollar-cost averaging into stocks at current valuations. Pause or reduce equity contributions in your 401k or redirect them to money market options. Don't buy the dip repeatedly as stocks fall. Wait for true capitulation when valuations reach historically cheap levels. Don't use margin or leverage. Don't trust traditional diversification. In crashes, everything falls together. International stocks, small caps, value stocks, growth stocks all declined simultaneously in 2008. True diversification requires different asset classes: stocks, bonds, commodities, cash. Don't listen to financial media celebrating new highs as evidence to stay invested. Major tops form during maximum optimism. The time to reduce risk is when everyone feels comfortable, not when fear is obvious. Don't tell everyone what you're doing. Wealth preservation is private. You will feel uncomfortable moving to cash while stocks continue rising. You will question your decision. Friends will show portfolio gains. Your advisor may push back, arguing your market timing. You must have conviction to withstand this pressure. The goal isn't selling at the exact top. It's reducing exposure before the major decline, even if that means missing the final 10 to 20% of upside. Common pitfalls include reducing risk too early and abandoning the strategy when stocks keep rising, reducing risk but lacking discipline to buy back when stocks become cheap, selling in taxable accounts without considering tax implications, and moving to all cash, earning nothing when bonds provide acceptable yields with greater safety. The successful approach requires both defense and offense. Reduce risk when valuations are extreme, maintain purchasing power in safe assets during decline, and redeploy when true value emerges. Silver shouldn't be 100% of your portfolio. Balance is essential. Growth assets, stable assets, hard assets, liquid assets. Nothing in this constitutes specific financial advice. Your situation is unique. Your age, income, risk tolerance, tax situation, retirement timeline, and spending needs all matter. Consult qualified professionals. What I'm providing is the framework for thinking about risk management during periods of elevated valuations and systematic fragility like we face in 2026. The broader truth remains, regardless of your actions. The current stock market reflects 15 years of monetary stimulus, not 15 years of fundamental business improvement. Corporate profits as a percentage of GDP are at all-time highs and reverting to mean. Valuations are in the top 5% of historical readings. Retail participation and sentiment are at levels seen only at major tops. Institutional positioning shows defensive rotation. The math doesn't support current prices with current interest rates and profit margins. The choice is yours. But remember what happened to investors who ignored similar warnings in 2000 and 2007. They lost half their wealth and spent a decade recovering. Remember those who recognized the risks and adjusted. They preserved capital, bought opportunities at discounts, and came out ahead. The difference wasn't luck. It was understanding that markets move in cycles, valuations matter over time, and sometimes the most profitable action is reducing exposure to protect what you've already earned. That's why this channel exists. Not to tell you exactly when to buy or sell, which is impossible to time perfectly, but to help you understand the fundamental principles governing market cycles so you can position yourself intelligently ahead of major transitions. We observe what institutions are actually doing with their capital, not what they're saying in press releases or earnings calls. Actions reveal true beliefs. Berkshire Hathaway, sitting on $325 billion in cash, nearly 30% of its entire market value, tells you something profound about Warren Buffett's assessment of current opportunities. Corporate insiders selling their own company shares at 5-to-1 ratios versus buying tells you they don't believe current prices are sustainable. Smart money raising cash positions to historic levels tells you they're preparing for instability, not betting on continued growth. These aren't random actions by uninformed players. These are sophisticated institutional investors with access to better information, better analysis, and better risk management than retail investors will ever have. They're responding rationally to observable risks, unsustainable valuations, deteriorating fundamentals, and systematic fragility built over 15 years of artificial monetary conditions. If this analysis resonates, if you understand that 2026 presents risks most investors haven't priced in, if you value protecting wealth as much as growing it, subscribe to this channel. We'll continue providing analysis based on historical patterns, fundamental principles, and observable data. The next several years will test investor discipline like nothing since 2008. Those who understand what's coming will navigate successfully. Those who assume the past 15 years represent normal behavior will learn painful lessons. Protect what you've built. Recognize that preservation of capital is the first rule of investing. Understand that sometimes the bravest action is stepping aside when everyone else is charging forward. The smart money has already begun moving. The question is whether you'll join them while there's still time, or whether you'll wait until the stampede for exits makes movement impossible. Nobody is ready for what's coming, but you can be. The information is here. The choice is yours.